Hello everyone! As you can see, I have my Thinkorswim platform loaded, and what I want to do today is sell an option in DIA, which is the Dow Jones Industrial ETF. Selling options naked is not a strategy that I recommend new option traders get into, but because buying and selling options are the building blocks to the trading strategies we're going to discuss later, it's important that we quickly cover the steps and fundamentals that come along with selling options. We prefer to sell options that expire anywhere from 30 to 60 days due to the accelerated decay. So for this trade, let's look out to sell July options that expire in 50 days. Here, I am presented with the option chain, calls on the left and puts on the right. The most important column that I have up, other than the bid and the ask, is the probability of in the money. If you remember from our buying options lesson, probability of in the money is also the same as delta, just displayed in percentage format instead of decimal. In order to change the column to probability in the money, just select the column header, then Option Theoreticals and Greeks, and then Probability of in the money. If you prefer delta, that's also available under this same menu. Most traders prefer probability in the money, but if you're not trading on Thinkorswim, your only option might be delta, which is the same thing, just in decimal format. In this example, I want to sell a call option, but must first decide on which call option to sell. And as we can see, there's a direct correlation between probability of success and profit. If I sell a 218 call, there's an 8% chance of this call finishing in the money, which means I have a 92% chance of failure. The profit is very small at only 22 cents, or $22 per contract, which also must be balanced against any transaction fees I pay for this order. As my strike prices go lower, the premium I receive for the trade gets higher. But as we can also see, so does my probability of success. What probability of success is the best one to select? Well, that really depends on a lot of factors and personal trading style. But as a general rule, I like to sell options with about a 10 to 25% probability of finishing in the money, which means I have a 75 to 90% chance of success. Combine this general probability of success with quality research, and for my trades, I consider my chances of success to be much higher. So for this example, I'm going to sell the 216 call at a price of 50 cents for 10 contracts. And to do this, I'm just going to left-click on the bid, check to make sure the quantity is right. Because I'm selling, there's going to be a negative in front, and change the price if I desire. Once everything checks out, I hit Confirm and Send. Just like with buying an option, we're going to be presented with some general trade details. First, we have the break-even of $216.50, the strike price plus the premiums received per share. As long as the stock trades below this level, we will make a profit. Our max profit is going to be the 10 contracts, which controls 1,000 shares, times the price of 50 cents for a total of $500. Our max loss is infinite because technically this stock could trade to infinity, even though we know that would never happen. We have our cost of the trade, which is our max profit less any transaction fees, and then our buying power effect, which we see is an incredible $37,000. That's a lot of money that's being tied up just to make $500. The reason for this is because, unlike buying an option, where our max loss is just what we paid for the option, selling options has unlimited loss potential, and because of that, the investment bank wants to ensure there's money secured just in case of a worst-case scenario. Just how much money the investment bank decides to hold on to secure this trade is really a judgment call by the bank. But as you can see, they are certainly going to hold on to a significant chunk. This is really the biggest restriction when it comes to selling naked options, as it ties up a whole lot of capital. Capital that is no longer eligible for any additional trading until the position is either brought back or expires. On second thought, maybe I better not put this trade on. Not because I think I might lose, but because the amount of money my investment bank wants to secure in order to execute this trade would seriously cripple me from making any more trades. A trade like this has too high of a capital requirement for the limited profit I am expected to make. There has to be a better way. And fortunately, there is. But before we get to that, let's have a quick look at selling an out-of-the-money put option. Going back to our DIA option chain, all the same properties that apply to selling a call also apply to puts. Only this time, we want the stock to stay above whatever level we select. Looking at the 200 strike price put, which has a 15% chance of finishing in the money and an 85% chance of finishing out of the money, seems like a good bet. I would sell this by left-clicking the bid, and the option will be loaded into the order entry area. I would then ensure that the price and the quantity are at the level I am seeking, and then press Confirm and Send. Our break-even for a put is calculated by taking our strike price minus the option price. The max profit is the total premium received. Our max loss is not infinite like with call options, as a stock can only go to zero, but it might as well be with a max loss of this size. And our buying power effect, although slightly better than the calls, is still quite large. This is also not a trade that I would prefer to take on. I know the Dow Jones Industrial isn't going to zero, so I'm not worried about that. However, I do want to implement a trading strategy that not only gives me the ability to sell premium, but defines my risk so I'm not hit with a huge buying power effect from my bank. Fortunately, that strategy does exist. And now that we have covered both buying and selling options, it's going to start getting a lot more fun from here.